Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. It's going to be a very, very turbulent time in our stock market over the next 1 month. That's a given. We're going to start an earnings season next week, and of course, the country is going to polls. That's something you all know. On this show, of course, we'll help you manage your money. We'll help you keep your goals in sight and make sure that nothing in your portfolio is derailed over the next 1 month. Grab a pen and paper and write down my email ID that's at the bottom of your screen. You can send me any question at all if it has to do with your money. Let's get straight to it. On this show this week, we'll help a young investor plan for his children's future and also manage to go on holiday over the next 5 years. In our product review, we look at the IDFC Sterling Equity Fund and we'll tell you why you should hold on to your insurance policies even if the value has gone down. All right, let me bring in Kumar, the CEO of Value Research and our in-house mutual fund expert. Dhirendra, thank you so much for joining us on Investors Guide. Now, before we talk about these questions that we've received this week, I want to talk to you first about the CPSC index. Now, this is the Central Public Sector Enterprise Index that we saw list last week. It went up about 10% on listing day, and that index is now available for retail investors to invest in either through an SIP or through a lump sum. Does it still make sense for those of us who did not put our money in during the NFO? Does it still make sense to invest in this index?
No, the case is not as strong. Let me just list you the reasons why one should have invested in this this ETF. People, investors, the NFO investors were getting two things which they are not entitled to now if you invest. One is 5% discount when you bought. And same investors, if they held it for 1 year, they will get a 1:15 bonus. So that actually was a big sweetener in the whole transaction. So one is a high quality portfolio that remains. Are these companies as attractively priced or as cheap as they were? No, not really. The sweeteners which were available then are no longer available. So I think the case is not as compelling as it looked at the NFO simply because price has moved up very sharply.
For those investors who got in during the NFO period right now who are holding this ETF, does it make sense to take some profits off the table, or should they be waiting for that 1 year to get that bonus?
No, they must wait for the next 1 year. This is where the comforting part of this ETF, that it is not as bad. It's a portfolio of high quality companies, but finally it is government companies, so that itself is a huge disadvantage. But those investors, who got it in the NFO must hold, because this 1:15 bonus is quite substantial. I think it is not possible to calculate the real return. It's in, the worth of that 1:15 bonus could be substantially more than what you have invested.
At any point over the next 1 year, should we be adding SIPs or making periodic additions to our investment to the CPSC index?
For most investors, it is not needed, because if you are investing in a diversified equity fund, they will have the PSU as and when needed. There is generally a very weak case for PSUs unless we have these PSUs which are so ignored that they become a compelling buy given their price. Otherwise, they are generally an avoidable set.
All right, avoidable set there. But if you did get an allocation to the CPSC index, remember Dhirendra said hold on to it for the next 1 year till you get that bonus allocation as well. Let's move on to our portfolio question. Well, Siddharth Narang has written in, Dhirendra. He says he's 30 years old. He's been investing in mutual funds for the long-term horizon. Now, he doesn't have a term cover, which is something we should worry about. He has a family floater of up to 3 lakh rupees for himself and his wife. He does not mention whether or not his children, he has 2 children, he doesn't mention whether or not they have been covered by health insurance. Now, these are his goals. He wants to build a retirement corpus for himself of 2.75 crore rupees, a very specific number there. He said he wants to set aside a kitty of 1.2 crore rupees for his children, both for the education and for weddings over the next 20 to 30 years. He wants to go on a holiday in the next 5 years, for which he believes he will need 5 lakh rupees. Now, before we talk about his mutual fund investments, no term cover, not enough family floater health insurance. Is that something he should address first?
That actually comes first, before you start investing, because that is a gap which you are leaving, and no amount of investment can compensate for adequate insurance. I think, even before you think about investing, go and get your fund cover, your term cover. And of course, if you don't have the adequate health cover, then any of your investment plan can be derailed, because somebody being unwell, and all your plans will go haywire.
So make sure you have enough insurance, and of course if you have questions about what insurance you should be buying specifically, you can write back to us. Let's now talk about his investments, Dhirendra. He's putting aside about 17,500 rupees into his mutual fund portfolio every month. He wants to know if this is enough to meet all of those goals he talked about. He's investing in the SBI Emerging Business, Axis Long-Term Equity, ICICI Prudential Focus Blue Chip, HDFC Top 200, Franklin India Tax Shield, Canara Robeco Tax Saver and HDFC Equity. He's looking at adding maybe a couple of funds to that portfolio as well. Now, interestingly enough, two of his goals, which is his own retirement and his children's future, are 20 years away. He does have something that's going to be in the next 5 years, which is the holiday he wants to take. Would you like him to run separate portfolios for those two goals?
Yes, ideally he should actually have a separate portfolio. At least mentally, it should be earmarked in a manner so that he knows how vulnerable or how comfortable he is likely to be. Otherwise, you run the risk of combining it all, have a false sense of being financially comfortable, just looking at the worth of your investment, and not really being able to connect with the worth of the cost of actualizing a goal. And other rule to be followed in his case, where everything gets consolidated in one or two accounts, that as he gets, he's 2-3 years away from goal, he should start methodically taking out money and start putting it in fixed income in a manner that he doesn't have to wait for 5 year, the holiday 5 year away. He should continue investing in this equity fund, but 3 years before that, exactly the way he is doing his investments, he should split that 5 lakh rupee over the next 36 months and take that money out methodically.
All right, Siddharth, if you have any questions at all about what you heard, you can write back to us. Email ID is on your screen. Let's take another question. Nagavendra Gopal has written in. Now, he tells us he can invest 10 lakh rupees for the time horizon of 5 years. He wants to know which of our portfolios he should invest in to get good returns. Dhirendra, obviously 5 years is too short a time to pick any of our aggressive portfolios. Which one would you rather have him use? One of our balanced funds?
I would rather suggest him the conservative portfolio, because even the stable growth portfolio is almost like an equity fund, because it can have 65 to 70% into equity, and for a 5 year term it may not be good enough.
So our conservative portfolio is on your screen right now. The idea is with this is to give you a stable return, and of course more importantly to keep that capital of yours secure. Let's take another question. Ravi has written in. He tells us he regularly invests in mutual funds. Now, he wants to put some money aside with a 1 year time horizon. He wants to know, should he be at this point investing in a liquid fund or an FMP? If you suggest he use a liquid fund, then how should he choose a liquid fund and begin investing?
So I would say be guided by the expense ratio of these liquid funds, and combine the return and the expense ratio, and that should give you some kind of perspective on the kind of return to expect. Liquid funds have been very rewarding in the last 1.5 years, and they are likely to continue that way as interest rates are not going down.
All right, and if you have any more questions, of course, you can write back to us. Choose an FMP if you're very sure of your time horizon, because you can't take your money out from an FMP. Before we go into break, now those of you who own a vehicle, get ready to shell out more for motor insurance. Now, effective the 1st of April this year, the IRDA, or the insurance regulator, hiked third-party premium rates for motor vehicles. Now, take a look at how this will impact your insurance premium for the year.
Even the most careful driver cannot escape an accident at times. And what happens if you cause damage to property, or even worse, cause a person's death or disability? Under the Motor Vehicles Act, you are mandated to pay for the damages which have been caused by your vehicle. You are also required by law to buy a third-party motor insurance.
Car owner buys a car for 3 lakhs or 4 lakhs or even 10 lakhs rupees. He can afford to pay 10,000, 20,000 as a liability, but there are cases in India itself where a software engineer or somebody at a good doctor, he has met with an accident. The insurance company were obliged to pay 7 or 8 crores of rupees. So you can jolly well imagine tomorrow you are on the road and somebody meets with an accident against your car, and he is a well-paid executive of a company. Your liability can run in crores.
As the insurance claims have risen over the years, IRDA has been collating data for the losses being reported by insurers, and the demands of a hike in third-party premiums have gotten louder from insurers.
So we've been wanting premium increases, because every year what happens in third-party insurance is The losses, they take time to develop over a period of time, because the accident takes place today, but it may be reported, the loss may be reported 5 years from now, 7 years from now. So it goes to as long as 7 years for loss to get reported on the policies issued this year.
Keeping this in mind, IRDA has increased premiums of third-party insurance from 10 to 20% for two-wheelers and cars. This means your insurance cover will go up.
In insurance, the third-party portion of your comprehensive insurance, if you have a new car, average car of say 5 lakhs rupees, the premium will be suppose 20,000 or 15,000 depending on which year of the car is there. Out of that, you were paying maybe 2,000 rupees at third-party insurance. Today, you will pay maybe 2,200, 2,250. That's the difference. So, in fact, the difference is only 200, 250 for a car owner. But the problem will comes that when you think only in terms of 10% increase, it's not the overall increase, but it's a part increase of the part premium.
Industry experts expect annual increase in premiums going forward, and hoping for a more deregulated market to determine the right level of pricing in the long run. For now, you may not even notice the pinch of a marginally higher insurance premium, but over the course of the next 3-4 years, you'll see the number inch higher.
Time for a quick break, but when we come back, Dhirendra is going to stay with us. We'll talk about the IDFC Sterling Equity Fund. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET. Now it's time for our product review. Dhirendra is still with us, but before we ask him whether or not we should stay invested in the IDFC Sterling Equity Fund, Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. This week, our fund in focus is the IDFC Sterling Equity Fund. Let's take a quick look at its track record. It was launched as a close-ended scheme in February 2008, soon after the downturn in the equity markets. In 2009, the fund managed to beat the category average of 93% by clocking in returns of 105% that year. The fund turned open-ended in September 2009. The current fund manager, Anirudh Naha, pays close attention to the CNX Mid-Cap Index. A substantial portion of the portfolio is tilted towards well-established quality stocks with low financial risks. The fund manager is also willing to pay a premium to hold on to stocks that meet his investment criteria. This intuitive stock-picking call makes the investor very dependent on the fund manager. Currently, the fund is ranked at 35 out of a total of 57 funds in this category. The fund's top 3 sectors are services, healthcare and financials. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you would have 2,299 rupees today. So should you invest in this fund? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, the last time we talked about IDFC Sterling Equity on this show, you gave it a good review. You said 4 stars. Since then, it's come down to 3 stars on value research, and the performance has been fairly mediocre. For those investors who are still holding on to this fund, what's your recommendation at this point?
No, given that, it was never the finest mid-cap fund, and of course, it started at a point since when, investors would have been generally disappointed. This fund was launched at the peak of the last market peak that we saw, February 2008. And since then, every year this fund has been able to beat its benchmark, which is the mid-cap index. But that is not good enough, because if you look at the universe of mid-cap funds, we have funds which are, most funds are beating the benchmark. Looking at, long-term returns, now this fund is about 6 years old, and looking at the returns so far, I find that there are many other funds which have done very well with, far greater consistency. The advantage of this, the impressive thing about this fund is that for a mid-cap fund, relative to all other mid-cap fund, it has been much more stable. It has not witnessed, as many sharper declines as most other funds, but it has not compensated with, adequate return, though it has beaten the benchmark every year.
But put on the screen right now the mid-cap funds that you chose at the beginning of the year as funds to invest in if you are looking for mid-cap. Now, for those of our viewers who are in IDFC Sterling equity, does it make sense at this point to move into one of the funds that you've recommended?
Yes, I would suggest that, it is time to look for better alternatives. Also because, you will have this sense of a lost opportunity, because looks like the market is on a kind of ground where things might get broad-based, and it is just beginning to happen. And if this sustains, then being positioned with a superior mid-cap fund might prove to be more rewarding.
Dhirendra, finally, what's your star rating of this fund?
Going by what has happened so far and its relative performance compared to most other mid-cap funds, and this fund is very well defined as a mid-cap fund, and it will remain one, I will give it a very average rating, which is 3-star.
All right, 3 stars for the IDFC Sterling Equity Fund on Investors Guide. Let's move on now to our hold or sell segment. Well, Varun has written in, Dhirendra, he's been investing in mutual funds since 2009 with an aim to create a corpus of 25 lakh rupees in the next 5 years to come. Now, he wants to know if his portfolio is on track. So he's already been investing for 5 years. So that's altogether a 10-year horizon, 23,000 rupees every month going into these investments. ICICI Prudential Focus Blue Chip is the first on his list. Over the next 5 years, Dhirendra, is this the fund to bet on?
Yes, given his time frame, it is better to be, with relatively conservative choices, and this will be one such fund, and it has proved to be extremely rewarding in recent past. So his last 3-4 years would have been rewarding, and I think he should continue with this fund given his time frame.
Well, the next one on his list is the IDFC Premier Equity Fund. It's a good performer, Dhirendra, but does it suit his time frame?
It suits his time frame, because this fund is not actually a mid-cap fund, or it's not a mid or small cap fund. It's a tactical fund, and it has succeeded with its tactics, and it has provided all the return across the all kind of market with far greater stability. And this fund also has the flexibility to change its color. So he should continue with this fund, and it has been a winner, and it's worth riding it.
All right, next 2 funds on his list are the Birla Sun Life Gen Next Fund and the Reliance Equity Opportunities Fund. Should he invest in both of these funds given where his time horizon is?
Birla Sun Life Gen Next Fund is a very unusual thematic fund which tries to capitalize on opportunity by a consumption story, particularly by the youngsters. That was the hypothesis. It's not a good diversified vehicle, so that is, he should consider moving his money into something which is more broad-based.
UTI Opportunities is the next on his list. Would that be one of those funds that are broad-based and will allow him to invest across the market?
UTI Opportunity is something which I like, and it has been a fairly large, large cap oriented opportunity fund. It's not an opportunity fund which tries to emphasize something narrow in the portfolio or a narrow focus in its portfolio. So from that standpoint, it's a kind of fund which he should continue.
Well, the last fund on his list is interesting. This is the ICICI Prudential US Blue Chip Fund, Dhirendra. Now, I know that this is something that you recommend, to have a global fund, specifically a US fund, in all of our portfolios. Is this the best one available to him? And given his time horizon, would you like to increase or decrease his allocation to this fund?
Given the interest rate differential, rupee will depreciate. But in the short run, we are seeing a reversal. So all these things will actually translate into a superior advantage, superior returns and an advantage for a regular investor in such a fund.
Before we wrap up this segment, we have one more question. Paritosh has written in, Dhirendra. He's been investing in the HDFC equity fund, so he only has one fund right now. He wants to move that investment into either our aggressive or our growth portfolio over the long term. Now, he wants to know how he should go about doing that. Does it make sense to pull all of the money out of HDFC equity in one day and spread it across the portfolio? What's your recommendation?
Yes, I would recommend him to pull his money out and substantially and spread it over either our growth portfolio or other constituents of our growth portfolio or the aggressive growth portfolio. And he can, well retain HDFC equity to the extent of, 15, 20, 25%.
All right. So if you have any more questions about investing in our portfolios or about the portfolios themselves, write to us. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for spending time with us this weekend and answering all of our questions. Coming up after the break, we'll tell you if it makes sense to hold on to your investments if the values have gone down. Stay tuned. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. This week, we've brought in Anil Sehgal to answer the questions you have on your insurance policies. Anil, thank you so much for joining us. Our first question comes in from a woman investor. Jayashree writes in, she says she bought the PNB MetLife plan in May 2009. The value of her investment has gone down from 60,000 rupees to 53,000 rupees in the last 5 years. She wants to know if she should continue to hold on to this policy. Anil.
Jayashree, the MetSmart Plus plan that you have is a unit-linked plan. Now, you bought it in 2009, so this is an old-style ULIP where the new regulations and the new rules on surrender values and surrender penalties did not apply. So typically in this plan, there are two things to consider. One, your investment returns will be determined by the type of fund that you have selected. And secondly, because the mortality charges will be deducted from the fund value. And secondly, there is an applicable surrender penalty. Now this surrender penalty typically decreases over the term of the policy and will apply at this time. So what you need to do is to really understand how this surrender penalty will reduce. Ask MetLife to give you an illustration that shows you how your fund value will grow and your surrender penalty might decrease over time. And then decide whether you want to continue or you want to discontinue the policy.
Well, our next question comes in from another woman investor. Swati has written in. Now, she tells us her husband is the breadwinner of the family and they have 3 dependents. Now, the interesting part is he has 4 insurance policies. All of them are from LIC, 3 are term covers, 1 is an endowment, and altogether they give him a cover of about 70 lakh rupees and he pays 31,000 rupees towards his term cover that she thinks is a little expensive. Now, this is her question, Anil. She wants to know if it makes sense to buy another online term plan for her husband because she wants him to have a cover of about 2 crore rupees, which she thinks is the fair value at this point. And she wants to know, does it make sense to stop all of the other plans before she buys this one? Should she buy this one from one company or should she spread it across different insurers? What would you have her do?
Swati, you already have a 65 lakh rupee cover on your husband's life. Now, typically at 16 lakh rupees annual income, I don't think any insurer would be able to consider an additional 2 crores. Based on, say, a 15 times multiple on your annual income, your total cover available may be in the region of 1.5 to 1.85 crores additional to what you already have. Now, what you need to consider is what your other requirements may be in terms of savings after your expenses, and so that you can balance the element of risk cover with your savings requirements and do not overextend on any one of these. So look at what your exact requirement on the total risk cover that you want to have, additional to the one that you already have. Now, having said which, as far as which plan you should consider, I would suggest to you to look for the online term plans. Now, within online term plan, there are a number of very good options available. Compare them, and based on your own requirements and based on your own perception, you can decide which one is better for you.
All right, last question of the show. Atik Saeed has written in. He's just been blessed with a baby boy. Congratulations, Atik. He wants to put aside 25,000 rupees every year for his son. He wants to know which plan currently available in the market would be the best one for him. So first of all, Atik, congratulations on starting so early. The fact that you've started now is really going to help your son out. Anil, of all of the child plans available in the market, which one would you recommend for him?
Atik, it's great that you are considering at this early stage to start investing for your son. If you are looking at investing in a life insurance policy, what I would suggest is look for child plans which are linked to your child's future needs, for example, education. Now, both traditional and unit-linked plans are available, and with it unit-linked also you have various options. So what I think you need to do is to take advice based on your financial goals, on which type of plan you want to select, whether ULIP or a traditional, and what is the term for which you want to invest, based on which you can compare the various options available for child plans. There are a number of very good options available, and select the one that would suit your requirements best.
All right, Anil, thank you so much for answering our questions on Investors Guide this week. Remember, if you have a question about anything, insurance, mutual funds, credit cards, loans, write to us. Our email ID is on your screen and it will always be a pleasure to hear from you. You can also reach me personally on Twitter. Thanks for watching.